everybody. I'm really excited to be here, not only with some of the world's greatest investors, but some of the world's greatest humans. I've learned a lot about my panelists, and we'll make sure we pick on them a little bit for their unique backgrounds. So I'm just going to sort of call out something I learned about each one of these folks before I let them introduce themselves. Stephen managed over $900 billion when he was at State Street before he joined New York City to run the pension system. He's also run 8 New York City marathons?
Yes.
8 New York, is that cool? Yeah, all runners, thank you. Stephanie was the CIO of Duke University before she became the CEO of her firm, and she'll tell you about that. And Elizabeth was the CIO of the state of Hawaii, super cool, before she joined GSAM. And she grew up on a cattle ranch, we just found out. And we'll unpack that at some point, or I will, off stage. So I'm gonna ask you all just to tell everyone a little bit about how much responsibility you have, how much AUM you have, and something very unique about the organization you're with now. Stephen, that's easy for you.
Yeah,
you go first.
terrific. Well, thank you for being here, everyone, today. I have the privilege of being the Chief Investment Officer for the New York City retirement systems. We manage about $255 billion across all manner of private and public assets. I have the added privilege of working with 5 separate and very distinct and unique pension plans for police and fire and teachers and employees of the city and non-teaching professionals in the school system. So it's been very interesting. Again, the engagement with trustees. I actually had the privilege this week of spending a couple hours up in Saratoga, New York, where I presented to 200 firefighters that are on the cusp of retirement, which was really wonderful. And what I really enjoyed about that engagement is you get to see the people that you work for and you're managing for the benefit of, and it was wonderful.
That's super unique. Stephanie.
Oh, thank you. It's such a privilege to be here, so thanks for having us at SALT and with this great esteemed panel of investors. As Jen mentioned, I'm the managing partner at Global Endowment Management, part of a 70-member boutique OCIO firm that I started with 2 partners about 15 years ago. We manage about $11 billion on behalf of endowments, foundations, and other long-term investors that are very mission-focused. So I think what I would say that's unique about what we believe we do, or frankly, the missions that we represent with our capital, we are seen in the marketplace as one $11 billion endowment. So we're competing against the MITs and Stanford of the world for really sought-after allocations. And when we speak to hot VCs, for example, they're very compelled by the societal issues that our institutions are really tackling, and they see GEM as sort of a conduit for that. They're not really interested in making wealthy people wealthier, but they really want to get closer to people that are trying to make the world a better place. So
Super cool.
we feel great about that.
All right.
Elizabeth Burton, you asked me to say something unique about my organization. Like, I'm sure there are many of you who used to work at Goldman Sachs. When I retire one day, I'm going to make a bumper sticker company called I used to work at Goldman Sachs. So you all probably know more about why they're unique than I do. So instead, I might throw out something unique about Hawaii. If you are in business development and you go on a trip to Hawaii and you wear a suit, we will think you are attending a funeral. So wear an aloha shirt and do not get it off Amazon. It better not be neon. It better not be a pineapple with sunglasses. It needs to be Ren Spooner.
Ooh, that's a great tip. All right, we're gonna start with the macro themes going on. Obviously, the Senate hearings this week on the banking system is on everyone's mind. Stephanie, I wondered if you could tell us a little bit about your thoughts about that. And you just put out a paper about cash management, which seems like a ho-hum issue, but not really these days. So tell us a little bit about your perspective.
Sure. And we were talking earlier with Stephen and Elizabeth about it too, so I'm sure they're gonna have some more things to add, because to be honest, it wasn't revelatory at all, but it was something that we thought was super important for really our smaller nonprofit organizations that have sort of put this cash management responsibility on the back burner, right? I mean, there really weren't interest rates yields to speak of, and their capital and resource constraints. They were focusing on other parts of their operation that really mattered. And as we all learned with the Silicon Valley Bank and other issues in March, really it catalyzed a focus on how cash management can really have an impact on enterprise. So we just put out a little white paper that basically got back to basics. It's things that most of you know and do in your everyday life, but not something that's really commonplace for them any longer. So we gave them 3 principles that we really use in the stewardship of our own cash. And first and foremost, it was to have multiple relationships. I know it's super cumbersome for small organizations to keep up with all of that, but if you have a little bit of a thought process and a plan early on, have some sweet vehicles, a couple of money market funds, set up the oversight and management of that, it's not nearly as difficult to implement. Secondly, it sounds really silly, but just invest your cash. A lot of folks, again, really got complacent in the last decade. They stopped sweeping money out of their checking accounts and into money market funds because, frankly, it didn't matter. And now it does. Interest rates are here, and we think, frankly, more sustainable. And so it's just part and parcel to something that we think is good practice and prudent. And then lastly, use your sweep vehicles. I mean, we have money at First Republic Bank, but everything over $250,000, of course, we have swept into a money market fund. We think that was something that CFOs, frankly, again, sort of overlooked back when it wasn't as important. But now something that we think really is prudent to do, and we're heartened by seeing lots of flows into money market funds as a result.
Anyone else want to jump in on that?
Yeah, obviously cash is important. Coming off of I hope you're right. I hope that the higher levels of rates are somewhat sustainable, meaning we don't go back to a zero interest rate policy at any time soon, because I do think it distorts valuations and pricing and leads to suboptimal investment decisions. But you want to exercise your cash. You're absolutely right. And it's interesting when you talk about what happened in the regional bank. I'd say disruption. It's not a crisis. But a lot of people look at those 3 instances in particular in the States and say those are all idiosyncratic, and there's some truth to that. They are specific to those risks associated with those institutions. But the conditions that actually underlie those problems, in terms of higher rates and embedded losses in bank portfolios still exist. So I'm not so sure we've seen the last of the bank challenges. I hope we have, but I'm a little more skeptical.
Okay.
But I do think as it applies to your cash management, you want to make sure that you're doing your due diligence on wherever it goes. So there's a heightened sensitivity right now, given the debt ceiling crisis around owning short T-bills and a money market mutual fund. So just things to be aware of.
So let's talk about the debt crisis. Janet Yellen said we might run out of cash by June 1st. Elizabeth, you had a point of view on this.
Yeah, so I don't want to necessarily comment on what I think the outcome of the debt crisis will be, but I think there's an important point that a lot of folks are missing on that. And that's, look, not all pension plans are the same, as we know, and not all allocators are the same. But the problem with the debt crisis is what's going to happen in institutional portfolios. So only once in the last 5 events have we really seen a massive sell-off. It was 17% in the S&P 500 one time in the last 5. Other than that, it's been down 4 or 5% approaching the deadline. But the problem is that this time, in June, about a third of, first of all, almost 100% of U.S. public pension funds have their fiscal year end in June. Some don't, but a lot do. And why is that important with this June number? Because let's say theoretically that there is a massive sell-off. Let's say it's 15 to 20%. We all know there's already a illiquid asset issue in U.S. public pension plans, where most of them are heavily overweight privates because of the denominator effect. If there's a big sell-off, not all pension plans do this, but some set their pacing allocation on private markets after their fiscal year end, and about a third of them are going through their asset liability studies now, between now and June. So if you imagine that there is a 20% sell-off, number one, it affects the 1, 3, 5, 7, 10-year returns on a U.S. public pension fund. So first of all, that's challenging because you could be under your benchmark. A lot of funds are still targeting a 7% target return in their portfolios, which is difficult. Not all of them are, but some are. But second, it's going to impact your ability to fund those private market assets that you had assumed, and you may have to pare that back. And while it might be a short-term issue with the debt ceiling, the 1, 3, 5, 7-year allocations are a long-term issue. As you all know, vintage year diversification matters very much. And it also limits your ability to be opportunistic and take advantage of some of those dislocations. So there's a second concern on this, and then I'll stop talking. But the buy the dip mentality is much harder when you don't have any funds with which to buy the dip. So it could exacerbate some problems. Now, note, this is only U.S. public pension plans, so there is a lot more capital flowing through the world. I am well aware of that. But that is a huge asset pool, and so it could cause more issues that people are thinking of just purely because of the timing.
And in terms of the bigger picture, we've been sort of waiting for this recession to happen for a very long time. Stephanie, you and I talked a little bit you do believe there will be a recession. I'd love to get sort of a speed round on recession, no recession, and when. Not that you can really predict the future, but go ahead.
Sure. I guess I'll start with the caveat that one, I think our firm's much more focused on manager selection than we are predicting recessions, or certainly the depth of them. And these two are much better suited to answer that question.
I'll make them answer too.
Clearly, we have to have a point of view. I mean, we try to ensure that our portfolio is pretty well diversified for whatever economic sort of outcome we're facing, because we have a lot of humility about our ability to predict the future for sure. But our CIO jokes that if there was a drinking game around the word mild recession, that we would all be in rehab or dead by now, given how much conversation there's been overall. I mean, obviously, we're looking at imbalances in the U.S. economy as to the fulcrum of whether or not the recession is mild or not. We firmly believe with an inverted yield curve that there will be one. But some of the things we're watching, of course, are levels of U.S. debt. In particular, if you look at household debt, it's post-COVID been about 5 years per annum. Corporates, it's been about 7% per annum. But what's really stark is the level of federal debt, which is actually about 10.6% annually since then. That's about 38% of 2019's GDP. So certainly something that we're focused on, and it's causing us to be somewhat more conservatively postured. We're underweight equities, we're underweight credit. We're holding some cash. We think it's going to be important to have some dry powder and be able to rebalance, because we think it's going to be volatile from here. And so we think that's a prudent course of action.
Can I press you on timing? 2023?
I would say that I think the signs will become more clear by the end of this year, and I think we're trying to counsel our nonprofits who really have to have a number of contingency plans. As you all might imagine, when you get into a recessionary environment, those people that are depending on distributions to fund programs are exacerbated. Those programs are more necessary when people lose their jobs and when we find ourselves in that kind of economic environment. So those contingency plans we're really pushing for them to have into the 2024 time period, but I can't get any more.
Who wants to go next on that one?
I'm happy to go. So this is something I think differentiates Goldman. If you look at the survey of economists on where they think the odds of a recession outcome are, it's at what, high 60s or something like that. We're at a 35% chance of a recession happening, and that is certainly larger than a 12 to 17% chance of any average year, right? But it's not our base case. And I think also, like even in the market, I've heard a lot of people talk the last couple of days about Fed fund futures and where those are pricing. I actually think like that is a reflection of maybe a bimodal outcome. Like if we're going into a recession or we need rate cuts versus, where we might sort of end up this summer. But, predicting the recession is not necessarily what I think is really useful, and probably you two would think, I agree with this maybe, but you need to be prepared for either scenario in your portfolio, no matter how right you think you are about this. And the problem is that we are likely to see higher inflation for a longer period. And when that happens, the correlation between bonds and equities tends to stay sticky and positive for quite some time. And the real problem, I think, is that now you're getting back to beta 1 portfolios across the whole board. And that has lots of ramifications. So, this is a little bit tongue-in-cheek, but do you care about diversifying your credit to be less risky if you're going to have issues in the equity market? No, because most institutional allocators have very high betas. So if you sell off 20%, you're probably down somewhere just slightly under 20%. So I think that that's a larger issue. So trying to prepare for some sort of blip in the equity market, I think is really important right now. Again, it comes back to that's really hard when you're limited on cash. And it actually, obviously, like you guys know this, but when you're watching the pundits, sometimes it's frustrating when they say stay overweight cash, because pension funds are very limited in their ability to stay overweight cash, right? We have asset allocation targets, and maybe the highest I've seen is a 5% potential overweight. So I agree with you. You need to have dry powder. It's just like the worst possible time to look for it. And I think we were joking in the room. That's why I think we're hearing words like portable alpha come back, because people are searching for that way to get exposure. But I mean, I haven't heard that in 10 years. So
we haven't had interest rates in 10 years.
Yeah. Stephen, let's get into portfolio allocation given all this. Some interesting things have happened to the New York City pension fund in terms of the way you regulate what you can do. Talk about that and how you're looking at allocation.
Yeah, so we actually operate under very old legislation that dates back to the 1930s. And it actually had a legal list of investments, and anything that wasn't on that legal list fell into the prudent investment basket, called the basket clause. And that basically constrains our opportunity set in terms of how much money we can put into, say, private assets, for example. At the end of last year, Governor Hochul signed in the legislation an increase in the basket clause from 25 to 35%. So like many other institutional investment managers, we're actually now going through a strategic asset allocation review for the 5 plans with the expectation of perhaps using a little bit more of that basket, perhaps investing a little bit more in private assets, private equity, venture, private credit, and some other assets.
You're going to have a lot of managers out here excited.
Well, it's actually a wonderful opportunity. And again, given the increase in short rates and the increase in base rates, it's also smart to look at what's changed in your portfolio allocation, how's diversification working, what's not working, and to tweak those. So we're pretty happy with the way the portfolios are structured today, but we are looking at potentially incremental changes to take advantage of that wider opportunity set in the changed environment.
So an increase in private markets investment, is that what I'm hearing?
I think so. I really can't pregame it because ultimately the decision rights are at the trustee level.
Sure.
But if I had to make a guess, I'd say that that's probably accurate. Perhaps an increase in private credit, private equity, perhaps an allocation increase to venture, real estate, infrastructure.
Anyone want to jump in on where you're seeing the opportunities in your portfolios?
It's funny, given our differences in size, we have such different perspectives about how those actions and decisions impact valuations.
Talk about that. What advantages or disadvantages do you have as a smaller organization?
I mean, we sort of believe size is the enemy of returns, except in credit in private markets, for example. And so we love to hear that large funds are starting to increase their allocations to private equity in particular, and mega funds, have garnered a lot of capital right now. We tend to traffic in small buyouts. I mean, it's an old adage, we were laughing about it. Like, we don't make money from financial leverage, we only make it from operational improvements. But we honestly try to really push on that with these, like I'm talking small, sub-$100 million funds. And so we feel like this type of environment should play to our advantage, and we should be fixing up these assets, be a bit more recession resistant, and be selling them to folks like Stephen. But we'll see. I mean, it sounds like that is somewhat of a panacea for everybody right now. And it's going to be interesting to see if the music stops and really where we end up. I'm sure you've probably got a more global view of that.
So I think actually global is an interesting word, and apologies to anyone who's heard me speak in the last month or so because I'm a little bit of a broken record. But one thing that I think is very concerning to me is that a lot of our ex-US clients are coming to the office. A lot of our ex-US clients are hunting for deals and calling and asking for the best opportunities. And our US clients are not as risk on. And I understand why. Unfortunately, sometimes we can get in this bubble think where we think we're competing with the 4 people around us, right? We're competing on a global stage for alpha. So the second you think, okay, maybe and now I want to add duration back into the portfolio, well, pretty sure everyone else is thinking maybe we should add duration back into the portfolio now too. So the problem is we're competing for the same pool, and I'm concerned. I spoke with one allocator. I said, do you have any plans to go to Asia? And I said, I went 2 years ago. Well, I think the concern for me is, it was okay to buy a house on Zillow, sight unseen during COVID when you couldn't go see, but you might have found out that, the 3rd bathroom needs like a $50K reno, or, someone passed away in that house and now it's haunted, but you wouldn't have known that unless you had gone and seen it. And I feel the same way about traveling internationally and hunting for deals. Like, you gotta go, you gotta get out of your house. Like, China's a great example, right? Like, the feeling in China right now is similar to how we felt when the restrictions here were lifted, right? It's not really something you can feel unless you're there. So my only observation is that if there's any trustees in the room or anyone responsible for the travel of your investors, please be supportive of them going out and hunting for deals and looking at local markets, because you have been able to make money just in the US the last 10 years. You haven't had to go anywhere else. I don't know if that's true anymore. I do think the US has certainly some reasons why you want to put money to work there. But I do think it's really critical that you go out, especially in this deglobalization and geopolitically frantic world, and look for where you can buy and look at what everyone else is buying, because you are not, like Oklahoma is not competing against Nevada. And those are just two examples. I didn't talk to them, so don't like, go call them and say I said this. I'm just giving, we need to get out of our own group think on this a little bit.
And I'm pulling something else out of what you're saying. You said to me when we chatted, you know, people think they're getting paid to sit on the sidelines. Talk about, you have a contrarian view on that one.
Yeah, I think, look, you're not wrong to say I'm getting paid to wait in some extent, right? So with the levels of shorter duration, sure, you can sit and wait. As Steve, you probably know, and as you probably know as well, shorter duration trades are harder if you have strategic long-term asset allocations that don't have a short-term duration benchmark, number one. But number two, sure, you're getting paid to wait until you have to, one, reinvest that. But two, everybody else is waiting too. It's like trying to get into a Def Leppard concert 3 minutes before it's starting. Like everybody is going to be
anyone trying to go anymore?
Maybe. I just went. It was awesome.
Okay, all right. Pour some sugar on me. Amazing.
Oh my God.
That's really fun.
Yeah, you know, I was raised on a cattle ranch. I guess I should like her more than I do. But anyway,
you have. I can see you want to jump in.
Yeah,
Go.
You know, those are great points. So we actually technically have a zero allocation of cash. Typically, we're strategic in nature. We're not tactical. So you're absolutely right. It's for us. It's not market timing. It's time in the market.
yeah.
Irrespective of the fact that you can earn 480 right now in your cash, it's not what we play at.
Yeah.
Totally.
It's very hard to do. And it's also very hard to explain to people you should hire me so that I can put your money into cash, right? There's justification on the job front there.
So I was really taken by Stephen and Elizabeth, their career journeys and what they said about working for, you know, a public system and what that was like, the purpose, but also sort of the impact it's had on your personal life. And I want to start with you, Elizabeth, if you're willing to share. You told me an amazing story how if you didn't work for a, you know, public system, your life would have been different. And I just thought that was really interesting.
Yeah, so my second, she doesn't know this, and now it's like, I should probably tell her before this gets back to her end of the day. But my second kid, my daughter, Summer, she's now 7 years old, but when she was born, she had some health issues. And at the time, my husband, he still has a very great career, but we were focused on my husband's career. And so I already had another kid, and I realized I was going to have to stay home with my daughter, which is noble and wonderful, but I'm not really a good stay-at-home person. I am like very hyper, for lack of a better term, and I really wanted to work, and I really loved my job. And I talked to my dad, who used to work for the Virginia retirement system and had also worked on Wall Street. And I was like, I really got to have a job or I'm going to be a really bad mom to my 2-year-old in addition to this baby. And my daughter needed medication every 5 hours, which was the issue. And sometimes she stopped breathing after it. So someone had to be home with her and I didn't trust someone else to do it. And so my dad was like, well, you should look at a public pension. He's like, look, it's going to be a very different life from what you've had in a private life, but you'll still have access to great minds. You'll be engaged. It'll be a lot of fun. He's like, but it's also harder to get those jobs. I think everyone thinks it's easy. It's actually not easy to get these jobs. So Andy Palmer gave me a flyer. He's the CIO of Maryland. And we tried this method where I would work really early in the morning and get to leave around midday and switch with my husband or a caretaker to help out my kid. And he said, I'll give you like 3 months to see if it works. And it did work. I got in very early, 5, 6 in the morning. And then I would leave, midday to go home and take care of her. And there were a couple times where I had to leave immediately because she wasn't doing well. And Andy was supportive of it. But I will be forever grateful to the government because this is pre-COVID, right? Like now you can work from home, but pre-COVID, you couldn't just say I'm working from home or working different hours. And I literally would not have a job the last 8 years if the Maryland State Retirement System hadn't given a flyer on me, and I would have been probably not a very happy mom, and I would have not been very engaged with my children. And so
I just thought that story was amazing and worth sharing. And sorry I did that to you, but okay. But I think it was really great. And Stephen,
I'm not going to cry. Cheer up.
You shared some equally really great story about your journey to the job that you have and also the sacrifices you've made. You didn't say it that way. You didn't call them sacrifices. I'm calling them sacrifices, but.
Yeah, I don't feel like I'm making any sacrifices, and I mean that sincerely. That I have probably one of the very best jobs in Manhattan. I have the privilege of serving 5 different boards of trustees with almost 800,000 participants and beneficiaries. It's a privilege. I get to look holistically. We have $255 billion. We're relevant to the markets. What we do makes a difference in people's lives. I love my team. It's a privilege to work for Comptroller Brad Lander. And I probably shouldn't say this, but I will. When you take one of these positions in the public sector, sometimes you really don't know what you're going to get in terms of your boss, who's an elected official.
Sure.
Brad's been absolutely wonderful to work with. He's engaged, he's intelligent, he's sincere, he's a wonderful leader. So that's been, I'd say, a really pleasant surprise. But it's also being part of the process where you can make a difference in the lives of people.
Yeah.
And as I said, I went up to Saratoga this week. I addressed 200 firefighters on the cusp of retirement. And I said, listen, your pension's gonna be fine. This is what we do, how we manage the risk. Your family's gonna be fine. Remember, almost everyone in that room has some affiliation with 9/11, if not at the site, with the cleanup. And they've lost friends and family members. So it was very endearing. And people came up after me and said, thank you for what you're doing. This makes such a difference to me and my family. It's great.
Nothing better than that.
Yeah.
Stephanie, I know you want to jump in on this.
Well, I mean, it's so much fun because they're so passionate. Anybody that invests, for nonprofits for a living feels like they truly have, the best possible job. They're totally motivated and inspired by the missions. I mean, the folks that we get to represent, from a large foundation that's focused on AI and how it's going to impact society and ensure that it's just and creates equity for everyone, from universities that are leading art and design schools that are focused on sustainability and on, equity and inclusion, or, one of our endowments that's truly the only private steward of the world's oceans. I mean, it's an amazing and a privilege to get up every day and get to go to work and try to make money for people that are addressing those kinds of things.
I just feel like this message doesn't get out a lot in the world of finance. Finance positions are viewed in a certain way, and I think they're viewed more as a Goldman Sachs job than the positions that you have had. And I think maybe we need to get that out a little bit more. Let's go back one more time, shifting back to the hardcore. You mentioned get out there and see it. Deglobalization is happening. How do you think about your outside the US investment portfolio now? It's so tricky. How are you thinking about that, Stephen?
Well, there are a number of uncertainties out there in terms of global economic growth and inflation. Geopolitical risks are peaked. That concerns me. But I also look for opportunities. I think you're absolutely right, Stephanie, that AI is something to really embrace and pay attention to, because it is going to change our lives. And it's not over 10 or 20 years. It's over the next 1 or 2 years. It's going to be really impactful. But we obviously are a global investor. We have more of a U.S. bias. I would suggest we're probably looking for other areas to invest outside of the States. We're a dollar-based investor, but if you were long, large cap equity or tech for the last 10 years, you did well. I think you need to think differently about the diversification of portfolio, the correlation of assets, and how you structure a global portfolio.
I mean, Elizabeth, you've thought a lot about this. And obviously you travel a lot, so tell us what you've been seeing.
One of the things that I love about financial services that it doesn't get enough credit for is I actually think finance is, and maybe it's because I used to trade MBS, and I think that fixed income and credit innovate more than any other asset class on the planet. And I think, I'll give a shout out, even though I'm at iConnections, to Michael Milken right here. I do think he innovated in high yield and gave access to capital to people who otherwise wouldn't have had access to. But my point being that if you don't want to go outside the US, or if you've got restrictions on your portfolio that prohibit you from investing in certain economies or locations or asset classes, the world of finance has evolved so much that there's so many instruments that you can now use to get access to that, that probably can help you with your struggles and asset allocation. So a swap is like a pretty obvious example of that, right? So if you think about Canada, when they had to, years ago, invest purely in Canadian assets or infrastructure, or have it 90% tied. So they looked at swaps to get exposure to ex-US markets. And so if you're unable to travel. Maybe the public markets or some financial engineering might help you get access to it. I would still encourage you to go do your own due diligence, or make sure your partners that you have hired are doing it. And by that I mean, if you want to invest in Japan, for example, maybe you have a partner that's on the ground in Japan, not someone that flies in from London once, a quarter. So just make sure you really trust those advisors, and if you have consultants, make sure they're also doing that legwork for you, because I think it's critical. Not all of us can travel. We all have budget constraints, but make sure you've picked like the best possible partners. It's like when you picked your real estate agent. Back to the house example. Like, she better have the same taste as you and better be really diligent as you. You probably just don't want to find her off Google. So you probably just don't want to find your manager off Google.
So we only have 1 minute and the countdown clock is on. You're all incredibly successful and at the top of your game. And I'm sure a lot of people here would like to be all of you when they grow up. What is the one attribute about you that has allowed you to have the career that you have? Stephen?
Resiliency.
Steph?
Humility.
Okay.
Probably my dad.
Oh, that's so nice. We have to tell your dad that. Her dad's 81.
He's gonna kill me now.
Runs marathons. I'm divulging everything.
Yeah, which he
anyway.
had me when he was, 70. So
Yeah.
just to be clear.
Anyway, thank you all. This was an awesome conversation.